Hey everyone, this is Kirk here again at optionalpha.com, and welcome back to the video recap that we do here each and every day where we go over our opening and closing or adjusting trades. So today we actually had a fairly busy day, so a lot of trades that we either opened or that were hedges, considering the market had a pretty tough day to start off the day. It kind of gained and rebounded just a little bit here towards the end of the day, which really bodes well for tomorrow being possibly an up day, definitely with the rally that we had into the close. Now, I first want to go over the one closing trade that we did have today. So this is on the vertical Qs, and we had a put spread that we had originally bought for about 97 cents. And today we closed out that put spread, that debit put spread, and sold it back to the market for a $113 credit. So it was a $16 profit, which is not anything to write home about, except this was a 50-50 trade to begin with. So by actually making a profit and this thing turning all the way around full circle, it was really good just to take this one off. It's one that we've had on for about a month and a half now, so one that we've been holding on very tightly to and has been pretty much a loss until today, so it turned a nice profit with it. What I wanted to show you guys on this one, because it's a little bit different, so again, a learning experience for those of you who are members, is that although the alert went out as the 9088, we actually went through the dividend cycle with the Qs. So the strikes in your account actually should be reflecting around 89.63 and 87.63. And what happens is that the strikes get reduced by the amount of the dividend for this case. So this is nothing bad. It doesn't mean that these are odd strikes that you can't get out of. And I'll show you on the actual trade tab of the Qs. This is the trade tab of the Qs for May. You'll see that in the strike column right here in the middle, that every single strike has an alternate strike right next to it that is around 63. So 82.63, 83.63, etc., all the way up and down. And that's because there are going to be people who have traded these options before the dividend, and then therefore they're going to be trading more or less those options to exit or close. Now you'll also see that there's just the regular 86, 87, 88, etc., just the round numbers, and that's for people who are trading around that same strike or had traded after the dividend had come through. So for those of you who had the position, I don't know what your system shows on Thinkorswim. It shows the strike actually adjusted with the dividend. In your case, it might not on TradeKing or whatever the case is. Hey, actually add a comment to this video. Let me know. I'd like to know what other systems are out there are showing this as the correct strike with the dividend reflected or not, just to help you guys out. But in any case, that was a good trade that we got out of today. You'll notice that obviously the Qs kind of came all the way back around full circle. We actually ended this trade back in February, so it's been a long time since this thing actually showed a profit. You'll actually see on the chart here that even though the stock rallied back up and the markets rallied back up towards the end of the day, we actually had a limit order that we're trying to sell another credit spread below the market. And you'll notice that implied volatility is starting to fall a little bit on us. It's now at the 50th percentile. It was much higher than that today. It was around the 66th, 65th percentile. So it was a really good opportunity. We just couldn't get the pricing and the fills to go through. We were just kind of stretching a little bit on our premium. And hindsight's 2020, we should have just adjusted our premium back a little bit to get that fill. All right, so going over the opening trades, I want to cover first just the two new trades that are not hedges. So everything else below here, these are all hedges that I will talk about in detail. First is Pfizer. So Pfizer is a really interesting one. We sold the 31.29 put spread. So we sold a put spread that was about $2 wide and took in a credit of 56 cents. I'm sorry, about $3 wide and took in a credit of 56 cents. So what we did here is instead of selling the 31.30, we just added the extra dollar here and sold the 31.29, so the $2 wide spread, and made it a nice big spread so we could take in a little bit more premium. So for Pfizer, what you'll actually see, FPFE, is that implied volatility is crazy high in Pfizer right now, probably because we do have earnings coming up in the next month or so. So what we did here is sold the 31, which is right about here, and then coupled it with the 29, which is well below it. But the 56 cents that we took in brings our break-even price down to around 30.50 or so. So that moves our break-even point down to around this range, even though our first strike is at 31. And this gives us a lot of room between the market and our first strikes and the potential to lose money. And also with implied volatility this high, this is just a really good implied volatility trade. Now we already have a lot of negative delta, so the reason that we're adding some of this positive delta is that I don't want to get caught in the other direction like we did a couple months ago where the market just had a quick dip lower and then continued to rally higher. So We're adding some premium on the downside right now, so premium below the market, some put spreads, etc., so that if the market does rally back up, then we have a little bit of wiggle room to make some money on. SLV is another interesting one. SLV is just a straight debit call spread. So SLV and GLD and a lot of the other commodities have had a really, really tough time in the last 2.5 weeks. And we still have a debit put spread in GLD. So we're still short gold. But at this point, we also want to be long silver for May. So the short gold that we have, the debit put spread in GLD is for April, so front month. Now we're moving out to May, and we want to be long silver here heading into May. So just to get some exposure because of the charts, and we'll show you that here. But silver, we traded the 18.20 call spread. The mid price in that is around $1, and we paid just over that at $1.05. Actually, this one was actually trading around 130 earlier in the day, and we set the price at $1.05. I did not think that this one was going to get hit today, but I definitely didn't want to pay 130. That's way over the mid price. It wasn't a 50-50 trade at that point. So what I did is I set a contingent order to fill at 105 should it hit that, or a limit order to fill at 105. It actually hit today, so that was actually good. I'm glad that we got into this. We take a look at silver. The first thing you'll notice, obviously, is implied volatility really, really low right now. It's at the 22nd percentile, even though silver continues to move lower. But really, I mean, this is the reason that we entered it. Take a look at this chart. I mean, silver's had a really, really tough month here and just continues to move down, down, down. Now, I don't know if silver will continue higher from here, lower from here, whatever the case is, but I suspect that at some point we might have a nice bounce up to at least around 20 or so. And you'll notice that silver has had a nice range in this 20 range where it's hit its head against 20 before in the past numerous times, and then when it finally popped up above 20, it came back down and retested that area as support going forward in about mid-March. So I don't know if silver will continue higher from here. We're giving ourselves plenty of time. We're giving ourselves all the way out until May expiration, so even past the dotted red line on our chart, which is April expiration. All we want is just a quick move up in silver and an opportunity to take some money off the table. So this is a 50-50 bet. This is not a high probability trade, but it's more of a directional play on silver. All right, so let's go into the ones that I had tons of questions on today, and those were the hedges in Yahoo, Priceline, and Pandora. So the basic gist of what happened with all of these hedges, because they all work exactly the same, and I'll go over each of them, but they all work exactly the same. And the reality is this: we had short credit put spreads in all three of these securities. So we were short a put spread in Yahoo, we were short a put spread in Priceline, and we were short a put spread in Pandora. Now, in basically all of these cases, at the time we made this trade, the stock had traded through our strikes to the downside, meaning that we were now in the money for our short credit spreads. And that's obviously not a good position that you want to be in. So what we did is, because the stock was running lower, had blown through our strikes, we went back in and sold a corresponding call spread against each of those positions. So by mimicking the number of contracts and the width of the strikes, we were able to then take in additional premium, which reduces our overall risk, and not have any additional margin outlaid. So again, I'll say that again, by corresponding the number of contracts that we sold. So if we were short 6 vertical put spreads in Yahoo, we went ahead and sold 6 vertical call spreads. And the width of the strikes. So if we were short a $1 wide strike, you want to be short a $1 wide strike on the call side. Same thing with Priceline. We were short 2 put spreads, so we sold 2 more of the call spreads. And in Pandora, we were short 5 of the vertical puts or credit spreads to the put side and sold 5 of the call spreads $1 wide. Now let's go to Yahoo so you guys can see. But again, the basic idea here is that we mimic the number of contracts, mimic the width of the trade. We add premium by selling at a credit and do not have any additional risk because of how we mimicked the number of contracts and the width of the strikes. So let's first go to Yahoo, and you guys will see exactly where everything's going here with Yahoo. So Yahoo obviously had a really rough day, but look here, implied volatility continues to be really, really high in Yahoo, so that's obviously working in our favor, allowed us to then go back in and sell that vertical call spread against our current position. If I go to the Analyze tab, and I'll bring up Yahoo so you guys can see exactly what I'm talking about here, you'll see our position down below. Now we are short the 38.37 put spread, which is in the money. So our 38.37 put spread, which is the original position here, was in the money. because Yahoo's trading at 36.68. So what we did is we went in and sold the 39.40 call spread. And so what that basically does is makes an iron condor out of Yahoo, centered around 38 and 39. So ideally, the best place that Yahoo could trade and move up to is 38.5 by expiration. So what does this do? This whole position overall reduces our overall risk. So where we had a massive, massive risk to the downside should these positions be off. So let me take off this hedge. You guys will notice that our max loss was around 408. So all you have to do is always look in the bottom left-hand corner of the screen, and you'll see exactly where the negative is on the red numbers. Email me if you have any questions about this, but we go over this in detail in one of the video tutorials. But you'll see here is that when I move my cursor around 37, which is where the stock is trading right now, we have a loss of 408. Should we do nothing at expiration? So should we not hedge, do nothing at expiration? Now, if Yahoo does continue to trade higher, we make 192, right? So that's obviously the upside, is that we continue to hold this thing through expiration and hopefully it just trades higher, right? But at this point, we want to be safe in our bets, so we want to go ahead and add that vertical spread that we sold today, the 39.40, and that reduces our downside loss to 288. So in case Yahoo does continue to trade lower, we've already reduced our downside loss to 288. We still have room to then sell a 38.39 and make this a butterfly. And we've increased the margin that we can win on the top side should Yahoo move up slightly but not too high to around 312. So the most we can make now is 312 if Yahoo trades basically anywhere between 38 and 39. So ideally what we want to happen with Yahoo is that Yahoo trades up around 38 or 39, which would be a nice little jump up, a couple of 4 or 5% from where it's trading right now, and for implied volatility to go down. We get both of those things that happen, we can actually leg out of these strategies and be a little bit more strategic about how we exit this position. But right now we have basically an iron condor in Yahoo. When we go to Priceline, it's basically the same thing. So what we did is we sold the April 1250, 1255 call spread. We gave ourselves a little bit more room in Priceline than we did in Yahoo, and I'll show you guys that here on the Analyze tab. So here's a chart of Priceline, and you'll notice exactly where our positions are. You'll see all of our positions down here in the bottom. So we were originally short the 1240, 1235 put spread, and we went up to the 1250, 1255 call spread. So same thing. Let me just show you guys exactly what happens when I just take off the trade that we made today. So this is the trade that we originally had today. Let me just scooch this chart here and reset these slices to the chart. There we go. So with Priceline today, you'll notice that Priceline is trading right here at this level right in the middle of the chart where it shows 1227. So that original trade that we had, the 1235, 1240 credit put spread, was now in the money. So rather than let this thing go all the way till expiration and potentially lose about $730 on this particular trade, what we did is we added in the short call spread. So this gives us a very narrow iron condor, at least on this chart. So we widen this thing out. We do have a nice window of opportunity here to make money between basically 1235 and 1255. But that reduces our overall loss to 376 regardless of where Priceline goes. So originally a $700 loss. Now most loss that we could potentially have is 376 with still room for adjustments. So we still left room to continue to adjust either side depending on where Priceline goes. But we'll be nimble about this, and we increased our potential to make money should Priceline close around 1240 to 1250. So we go to the charts of Priceline, and obviously Priceline had a really, really tough day, kind of rallied back here at the end of the day. We have a nice range in here between 1240 and 1250 that we want Priceline to trade at. But the biggest thing we want to happen is for implied volatility to drop. This would increase the potential for profit for both of these trades. And what we ideally want to do here is be a little bit more nimble like we have done before in the past with the diamonds and the spies, etc., and exiting the trade and legging out of the trade just like we legged into the trade. All right, so the last one is Pandora. So same thing with Pandora as with Yahoo and Priceline. We went in and sold the 33.34 call spread. We took in a credit of $25 per spread that we sold. We'll go to the chart of Pandora. I think Pandora was one of the ones that got hit the most today. It was down about 7% at the end of the day. But you'll notice again, implied volatility is still very, very high in Pandora, and our credit spread is the 34.35. So you'll notice we gave ourselves a little bit more room in Pandora, obviously, to make a bigger window here for profit. I'm sorry, the 33.34 in Pandora. Now originally we had sold the 32.31, so instead of making this a butterfly, we could have sold the 32.31 call spread and made this a butterfly instead of the iron condor. But what we want to do again is give ourselves a bigger window of opportunity to make some money, and then also more room to adjust this call spread down if Pandora continues to fall. So like I've done with all the other ones, I will take off the hedge that we entered today so you guys can see what our position looked like at the end of the day. You'll see that the max loss that we could have here is around 375 had I done nothing on this, and max profit of 125. That's if Pandora traded basically anywhere above 32 at expiration, which it could obviously do, but we don't know what's going to happen. So we went in and sold the call spread, the 34.35 or 33.34. That reduces our max loss to 250 even, so it's basically an even trade where we can make 250 or lose 250. And as always, what we want to have happen is Pandora to trade between about 34.5 to 33.5 on the top side. This gives us a nice window of opportunity here to make some money on Pandora should implied volatility drop and the stock rally back up. But regardless of that happening, if that happens, that's great. What we wanted to do at this point is protect the downside, so reduce our loss without adding any additional risk. And that's exactly how you do it on these credit spreads, is go in, if you have a credit spread and it goes in the money, whether it's the put side or the call side, and go in and sell the other corresponding spread against your position. And that creates that iron condor that we're so used to. So most people are really used to trading this thing right off the bat, trading a big wide iron condor right off the bat. And we've done this here on the website. But what they're not used to is going in here and hedging current positions that go in the money. Now, not all of our positions are like this, and these are three really good examples of just how it happened to work out today, that all three of these got executed today. So, as always, I hope you guys enjoy these videos, and we always like to go over a lot of detail on this. Please add your comments or questions right below the video. I want to get your guys' feedback on if this is helpful. I know a lot of people love the Analyze tab, so I'm going to start using that a little bit more so you guys can visually see where the profit and loss lines are on the chart. But other than that, I hope you guys enjoy these videos and happy trading.